Property tax, 3 main areas where you can get deductions for your property. Stay tuned. Good morning, episode 310, property tax. Everybody hates tax, but everybody loves deduction. Mark Nova and Harry, welcome.
Good morning.
So hey, Harry, last time I went bananas, last one Harry did, and I think you've helped a lot of people, so we had to bring you back on it again. Thank you so much.
No problem. Pleasure to be back.
Yes, so last episode we touched on a lot of people working from home, what you can deduct and sort of the levels. And I think it was very simple but very eye-opening for a lot of people. Obviously through COVID, everyone's sort of working from home and they're buying stuff, but they're not always thinking, hang on, maybe I can claim this back, because they're not used to being able to do it. And a lot of people have that with their deductions for their house, their investment property. So this morning, let's cover some main things where people can implement straight away and open their eyes for what they can do.
Certainly. So today's a very interesting topic because it pretty much impacts everybody with a rental property. So if you've got a rental property, then it's important to pay close attention to this, because there could be thousands of dollars that you're missing out on in regards to tax deductions. So when the year's finished, your agent provides you with an agent statement with your costs that you've already expensed, such as cleaning, strata, gardening, repairs and maintenance, all of that. There's really no point in going through all of that today, but my top 3 that I find that a lot of landlords are missing out on are these. So the first one is depreciation of the building itself. So it's not an actual cash outlay that somebody has incurred. It's still a tax deduction, even though you haven't paid anything. It's a non-cash tax deduction. So the actual building that you buy, the new building, does wear and tear. And in fact, that can be depreciated over time. So it's something that property investors miss out on. And I see a lot of it in tax returns that I review, that landlords have no idea that you can actually depreciate that.
Even if it's a strata unit, that they're still entitled to that?
Yeah, look, it depends when it is.
A unit in a house, and I always hear from clients, because that's not new, they didn't think they could.
Yeah, so from 2017, there was a new rule that was put forward. So anything purchased after 2017 has to be a new build. So the newer builds like the Meritons, the Mervacs that are going up, if you've bought one of those units, then you can certainly apply to get this Div 40.
So is that appreciation or depreciation, or is that the same thing?
No, depreciation.
Depreciation. So if you've bought a unit 2015, it's 5 years old, there's still depreciation you can claim.
Yeah, no, you won't be able to, claim part of that. So the newer build, we're talking like the new build that went up in DY, the Mervac building, the newer builds.
Yeah,
Meriton, yeah.
Is that the same as when you get like a depreciation schedule? Is that
exactly right? Exactly right. Yeah.
Okay, so if we do this like mathematics for dummies, say like an average person's earning 60,000 a year, on average 70,000 a year. Say they have an investment property in that's worth 750,000, a 2-bedroom unit, they own it. Over a 5-year period, if they forget to claim tax depreciation, how much are they forgetting? How much money they're losing or not going to be claiming? Like, are we talking $500 over 5 years? Or are we talking like 15,000? Like, what the cash in pocket if they're an average income earner owning average investment property, how much cash injection into the pocket is the negative? Is the depreciation going to give the average punter?
Yeah, so you need to call in a quantity surveyor because it's actually a very complicated calculation to do. They'll assess the building and the age of it, and they'll come in and tell you what you could claim. So pretty much it's 2.5% of the cost that they allocate to your building or unit over 40 years. So you claim it over a period of time. It's really difficult to say what the average earner would get from a tax deduction perspective because every building's different, you see. So
yep. But I think especially
but are we talking 500 or 15,000? Like give us something.
Oh, there's a range of between $1,000 to $4,000 in any year you could claim on an average unit that I see. Yeah.
So that's big.
Yeah.
That's big. And that's something very simple, like a quantity surveyor, I believe, for tax depreciation is like $500, and you
that's right. Yeah.
Get $4,000. Obviously, the newer the build, the more depreciation.
Correct. Yeah.
So, and that's not a one-off. If it's 4,000 that year, next year could be 3,000, next year could be 2,000. But that $500 that you do once could get you $5,000, $10,000, $15,000 in tax benefit.
It's an ongoing deduction, correct? Yeah.
So that's number one. What's number two?
So number two is the actual fixtures and fittings or the equipment, the items inside the unit as well. So things that aren't part of the building, like ovens, dishwashers, all of that, they all get depreciated over time. So you can depreciate that as well over a certain period of time, over 4 years, 5 years, depending on the item. So that's a tax deduction as well.
Even if you don't have the receipts for them because you just bought the property, not the oven, but obviously the oven's in the property?
Yeah, you'll have to install it new. It would have to be a new item that you've put in, not a used item. Yeah.
Okay. So very important to keep the receipts there.
Yeah, when you're buying new items, yeah. The other point I wanted to make was to do with borrowing costs as well. So when people go to the bank and they borrow, the bank obviously does a lot of due diligence. They would do evaluation. For some commercial properties, it could be $10,000 to $20,000.
Yeah.
And people forget about that when it comes to tax time. So valuation of properties can be amortized over 5 years. So if you've paid for loan establishment costs, mortgage costs, all of that, they can be amortized over 5 years. So don't lose those records.
The lawyer.
Wow.
Well, the lawyer costs are capital because they form part of the cost base of the property because you're not incurring that while it's earning income. So you can actually, it's like stamp duty, forms part of the cost base, lawyer costs, but purchase and sale of property. Yeah.
Kitchen, bathroom, that's a capital cost?
Yeah, that's huge. Yeah, that gets depreciated. Yeah.
Got it.
Yeah.
Hey, Harry, I had a quick question that just hit my head back on the new building depreciation. Is it true that if you claim that new building, you own the property for 10 years, you claim that new building depreciation or building depreciation, if it's not new, even if you're pre-2017, you can still claim, guys and girls, if you missed that. But you have to pay that back at the end, apparently. Something's got to be paid. There's an equaliser at the end on that.
No, I haven't. No, I don't think there's anything to be paid back at the end. Not to my knowledge.
Doesn't come off your capital. Okay, so there's no capital.
It's not like a lease or balloon payment for a car or anything like that. No.
And it doesn't add to your capital growth. No. Okay.
No.
Cool. What else?
And one thing, the subleasing of a residential room or subleasing of maybe part of your office. I think a lot of people are doing that now just for that additional income. How can that be applied for residential and commercial? What would you recommend?
From a tax perspective, it's critical to speak to your real estate agent because you need to be renting out that room for market price. If you're not renting out that room for a market rate, then all of your expenses need to be brought back down to what discount you're providing. So if you've got a room that's marketed at $500 a week, and then you are renting it out to a friend for $250, you're providing a 50% discount, all of your costs related to that renting out of that room need to be apportioned by 50%. Need to be reduced by 50%.
Yeah.
So that's a critical point.
And what would happen if you're leasing the property? So let's say the rent's 20 grand a year as an expense, but then now you're getting income. Will that sort of even itself out, or would you have to say that's income and you keep your expense? Like, are you not going to get hit by having, or does it sort of just look at it as that will just go to expense?
Yeah, the same rules apply for subleasing. You just got to make sure you're actually allowed to sublease when you do get a lease. That's an important clause in the lease to see that. But the same rules apply to just a normal investment property.
Income and expense.
Yeah.
Cool. Anything else you wanted to add on to that, Mark? Any questions there? We got Amanda from Canada watching. Thank you for watching. International, global.
Yeah, look, I think it's really important that like this. There's been the thing that I love about talking with you, Harry, is this is stuff that you forget. You actually forget to ask your accountant. You don't know to ask your accountant, and you're giving this information away for free as a pro. And I think in COVID, a lot of people's tax situation has changed. So what's actually happened is their tax environment's changed a lot or little. Homework, renting and buying furniture for working from home, renting office because you're working from home, travel expenses, everything is actually changing at the moment. So I think it's really important that people are actually a pretty eagle eye on this sort of stuff, because they could be leaving a hell of a lot of money on the table and stuff like. It's not about people are out to get the government or the government's out to get people, but everyone's got rights, but people aren't exercising their rights, and that's money left on the table.
Yeah, exactly right. You need to know what you're entitled to. That's the policy of it, and you don't want to miss out on things. But one important thing I did want to bring up is when you do claim these costs, you need to make sure the property is available for rent. So what that means is it doesn't mean the property needs to be earning income. It just means that the property needs to be advertised on the market for rent. So yeah. So you don't. I mean, obviously you can't just advertise to your social network or your Facebook, but it needs to be on the large domains like realestate.com or domain.com. You need to prove that it's actually advertised.
Wow.
And if it is, then you can claim all of your expenses.
Because a lot of people worry about that, where they've just bought a property, they do renovations, and they're going to rent it out. So like, does it count? So as long as you have it advertised for lease, coming soon, do the work to it, you can claim it. Or in between tenants, as long as it's been for lease, you can show it's actively. That's big. I know a lot of people worry about that. They're like, well, I did the works before I had a tenant. So the key thing there is have an ad online saying for lease, coming soon, available in 4 weeks. Get the works.
Yeah, you can't really say coming soon or available in 4 weeks. You got to really say available now.
Okay.
That's the trigger. It's got to be available now. Obviously, it's hard to do repairs while it's available now, but it has to be available to rent tomorrow or today, type of thing.
Okay.
while you're doing
So
the work.
just to take that from the top, if you are going to be claiming a tax deduction, whether it's negative gearing, you're just renting your property out, or even if you're going to rent out your room in your own house,
Yep.
is that you still need to have it formally advertised?
With the rooms, yeah, exactly right. Yeah, it
Yeah.
has to be advertised for rent if you want to claim any type of deductions against those premises. Yeah.
Because I guess you want to sort of show that it's been open market, fair market value that's been placed on it. And how would one arrive to market value? Well, there's no better way to arrive to market value than actually putting it to the market.
Yeah.
So it's pretty important that people keep a screenshot of that where it appears at the very least.
Yep. Yeah. I mean, have a record of where you've advertised the property and for what period, because that's critical. And I'm sure the domains will give you some kind of docket or receipt to show that you're online for that period of time, and that's evidence. Or even, your real estate agent could sign a declaration to say that we advertised the property during this period. That can be done as well. Usually the first option is better.
Substantiation.
Yes.
All right, perfect. Well, anything else you add on to that? 15 minutes flies when you're talking about tax.
Don't like tax.
The other thing that's come up that a lot of people forget about, that the rules changed in 2017, is to do with travel costs to your rental property. So prior to 2017, you could actually drive, if you had a property at the South Coast, you could drive down to that property, do a few repairs on that property, do a bit of gardening, and then claim all of your fuel, your travel down there. But that's all been scrapped at the moment. So unless you can prove that you're actually running a business of rental properties, carrying on a business, then you can't actually claim the travel costs. So a lot of landlords still think that travel to a rental property you can still claim, but that's actually been abolished.
I reckon a lot of people may have been buying down in Melbourne, the coast. Every time they go up there, they search for their property. Yeah. That would be a good way.
Yeah, a lot of people have properties in their SMS. Yeah, a lot of people have properties, in their SMSF, and they drive down to repair it, and they think it's deductible, but it's actually not.
So since
a lot of people are traveling the world doing the same thing.
Yeah.
Yeah.
Any other big changes like that? Because I reckon that's very significant that nobody knows. I reckon there's a lot of people out there still collecting their petrol receipts, the flight tickets for that that property. Yeah,
look, I think people tried to take advantage of the system, and it was just too much of an overload of deductions coming through on that basis, and the ATO said, we're going to scrap this. So when too many people try and take advantage of things, then the ATO step in and change the rules. So that's how it works. Yeah.
Yeah, first class tickets up to Queensland to see the investment property.
No.
Yeah. Alrighty. Anything else you want to add to that? Thank you again very much, Harry, for coming on.
No problem. Look, it's an area that affects everybody, so I think it was important to talk about it. If you've got a rental property, then this sort of webinar really affects you, and it's good to speak to your agent. It's good to speak to your accountant. Good to speak to your lawyer. Try and get as much professionals around your decision making as possible, because that helps in remaining compliant and making the right decision down the track.
Yes, and I've put your details into the conversation as well, because if you don't have an accountant, I reckon a lot of people may have just bought, they never really used an accountant because they had a simple summary, and Harry's details that you call, and you're local, where you, Milson's Point. Yeah, so awesome.
All right, fantastic.
Thank you very much,
legend.
All right. Good to chat, guys.
Thank you so much, buddy. It's unbelievable what you've done, and it's very generous of your time for people. And I guess if you are without an accountant, the perfect man for the job right in front of you. Thanks, buddy.
Appreciate that, Mark. Thank you. Thanks, guys. Chat soon.
See ya.